Stocks slip again with declines significantly outnumbering the advances today. Autos are the only notable gainers, while capital goods and energy are the big drags in the market.
RBI sends a stern warning to NBFCs on adhering to IT rules that cap the amount of cash loan at 20,000 rupees. The practice, predominantly in gold loans, is negative for lenders like Muthoot and Manappuram, though the former doesn't anticipate a big disruption.
Two-wheeler stocks rev up following the positive commentary from Hero MotoCorp and TVS Motor on growth and profitability, riding on a revival in the rural demand.
L&T slips despite posting mostly an inline set of numbers and a strong order book position after it guides for a weaker than expected margin outlook for FY25. Analysts retain their positive stance but trim target prices.
And investors trim their investments in equity funds to under 19,000 crore rupees in April from over 22,500 crores in the month of March, even as they upped their allocation to small and mid caps at the cost of large caps. Hybrid funds proved a bigger draw in April. Hello and welcome. You've tuned into Business Lunch. I'm Nisha Podar. With me is Ekta Batra. Hi, Ekta. So the pressure really continues in the market. And apart from other events, the big event of the elections probably is also weighing on the markets, apart from the earnings season that we are into right now. Let's take a look at the market at lunch hour then. Nifty 50 at the low point of the trading session. There has been a sudden fall in Nifty 50, over 1% down in trade at the moment. And taking a look at the rest of the indices as well, it is down and out. A lot of the large caps have not shown resilience, but only two pockets, Ekta, over here. While the market strength is so weak, two pockets, that is some of the IT names and the auto sector. They are the outliers and the outperformers today.
Yes, absolutely, Nisha. You know, I just want to point out that there's going to be a lot of focus on the PSU banks. We have State Bank of India, which is going to be releasing its numbers. Press conference is at 2:15 p.m. So there is going to be some amount of excitement when it comes to State Bank of India numbers. The stock is a little lower ahead of it, so it's just about lower by around 0.3% at this point in time, going into its numbers with a little bit of marginal weakness. Otherwise, there are a lot of stocks in focus on account of result reactions as well as possibly preempting on big moves ahead of numbers. So Tata Motors, for example, would be case in point, comes out with its numbers tomorrow and is showing traction on the upside, up around 2.3% at this point in time. Hero Moto has had a good week post numbers, so it's up around 5-odd%. And on the downside, we pointed out L&T, which is down around 5-odd%. Dr. Reddy's, which has lost around 6-odd% post its numbers this week, is losing a little more ground today. So that stock is down around 2.3%. So a lot of stock-specific frontline action taking place in today's trading session. As of now, we have the Bank Nifty, which has shed 600-odd points. So do note that. And we have the sensex, which is now down around 776-odd points. But let's begin Business Lunch by focusing on gold financiers. They are in focus after receiving an RBI advisory telling them to strictly adhere to the Income Tax Act provision on cash disbursements. Ritu has more on this story.
The Reserve Bank has issued this advisory to NBFCs, largely gold loan NBFCs that have a presence in Kerala, to strictly adhere to the income tax provisions on cash disbursement of loans, plainly cautioning them that no NBFC should disburse loan amounts in excess of this 20,000 cash limit as per IT rules. Now, the letter has not really come out of the blue, because if you recall, RBI recently took action against IIFL Finance for its gold loan business, where among other reasons, the breach of cash dispersal limits for this gold loan was cited as one of the issues by the regulator. Now, we understand that after that, several large gold loan NBFCs reached out to RBI to seek clarification on whether this 20,000 rupee cash limit had to be strictly followed. Now, keep in mind, RBI scale-based regulations clearly refer to these rules. The action on IIFL Finance was also intended as a message to the system. But despite this, we understand some players continue to flout this rule. So it is in response to this that RBI's Department of Supervision issued this letter to NBFCs, to the likes of Manappuram Finance, Muthoot Finance, etc., asking them to keep this 20,000 rupee limit in mind. Now, Morgan Stanley says NBFCs will gold lending business will need to make some operational changes, and there could be a transient financial impact as well, which should be manageable. Muthoot Finance, Manappuram Finance, of course, in focus. It notes for Manappuram, for example, 40% of disbursements are happening in cash. For Muthoot, 40% of the gold loans are actually online. So it says in the near term, there is likely to be a negative sentiment for both of these stocks. And it also notes that Muthoot has been investing in digital initiatives, so there should not be any major friction. We in fact spoke to the MD of Muthoot Finance earlier today, and he said that there should not be any major challenge because of these changes.
This is actually not any selective instruction. It is a universal instruction applicable to all NBFCs. Whether big, listed, unlisted, any NBFC, this is applicable. Because 80% of customers even pay their interest occasionally through the bank channel. So it is not we don't see it as a challenge. And next second part is, if they are not going here, where else are they going to go? Because all NBFCs, this is applicable. Those numbers are very minuscule, and we will have no difficulty there. So I don't have any numbers there. It's nothing significant.
All right, and shifting focus to some of the important earnings for the day today. Well, L&T reported a good set of fourth quarter earnings, and Vivek, our colleague, joins in now to get us up to speed with the numbers and the guidance and much more in terms of analysis. Vivek, tell us.
Well, you're right. So L&T, if you just look at Q4 and you look at FY24, absolutely nothing to complain about. The company managed to beat its own guidance across all of the parameters. The only blip being the company was unable to meet its margin guidance. But what did the street didn't like? The street didn't like the fact that the core EBITDA margin guidance for FY25 was below what the company had earlier alluded to. And this is something that has seen a whole host of brokerages go ahead and cut their estimates, and which is why you're seeing the kind of sell-off in the stock today. But let's analyze the results a little more in depth. Number one, if you're looking at the guidance check as far as FY24 is concerned, the company had given a guidance of 20%. What actually came in was over 30%. A revenue growth guidance was given in the range of 12 to 15%. They beat that too, came in excess of 20%. Narrow miss as far as core EBITDA margin guidance was concerned, came in at 8.2%. This is below what the company had earlier guided to, in the range of 8.25 to 8.5. Even that particular range was actually trimmed down lower at the end of Q3. Now coming to FY25, what is it that looks quite good? Remember, on a very, very large order book of over 4 lakh crore, the company is saying that they are expecting order inflows of almost 10% on a year-on-year basis. And despite very strong execution in FY25 in terms of top line, on that they are seeing a growth of over 15%. So that is the good part. What is the bad part? Core EBITDA margin for FY25 seen flat at 8.25%. The street was expecting something in the range of 9%. So that is where the key disappointment lies. What is Jefferies saying? Jefferies maintained his buy stance. They've cut the target price to 3970. They're saying that FY24 order flow growth was 31% versus a guidance of 20%. Prospect pipeline is up 20% and gives upside scope potential for management's 10% year-on-year growth guidance. Revenue guidance is 15%, which actually looks low according to them, given the fact that FY24 orders was quite strong. CLSA 2 has cut its target price. They all have a positive stance, but they've cut the target price to 4151 rupees. They're saying that the lower margins is a problem, and despite likely slowdown in the Middle East capex, they do continue to see very strong order inflows.
On top line, since we have had a very large base of orders of almost 3 lakh crore, and considering that maybe 4 or 5 months we might lose out in the government formation, new government, all of that political issues, we have assessed a growth of around 10% in terms of fresh order intake for the FY25. But looking at our order book of 4.75 trillion, we do think that the revenue growth would be around 15% or thereabouts. We do think that the margins that we will report on 15% revenue growth for the core businesses would be around the current levels, which is 8.25 thereabouts.
Okay, so that's L&T. But let's focus on some buzzing stocks. Two-wheeler stocks, TVS Motors as well as Hero Motor are surging on the back of their Q4 numbers and positive management commentary. Sudarshan is here giving us all of the details on this. Sudarshan.
So in this subdued market, one sector that is outperforming is two-wheeler, and this comes on the back of strong numbers reported by Hero MotoCorp and TVS Motor. Both these companies have reported earnings better than estimates and are significantly higher even year on year. First, talking about Hero Moto, margin remains above 14% and it's up almost 100 bips year on year, and company says it sees multiple tailwinds for the sector over the coming quarters and will be driving market share gains. For TVS Motor, reports margin of 11% for third straight quarter and it's at 11.3%. Revenue is up 24% and EBITDA has risen 36%. And company says EBITDA will continue to improve quarter after quarter and two-wheeler industry to see a healthy growth this year, and also company will see better recovery from rural market. Now talking about brokerage views on both these stocks, first on Hero Moto, Jefferies has a buy call with a target of rupees 5,650 per share. It says EBITDA per vehicle has risen 5% sequentially to a new high, and two-wheelers are poised for strong double-digit growth over next 3 years, and it sees 17% EPS CAGR over FY 24-26. CLSA has an outperform rating on Hero Moto with a target of rupees 5,280 per share. It says rich product mix and reduction in raw material costs impacted earnings positively. Now on TVS Motor, Bernstein has a market perform rating with a target of rupees 2,050 per share. It says Q4 results are on expected lines, with volume being a key driver, and it's a preferred pick and stacks up after Bajaj Auto in the pecking order. Jefferies has a buy call with a target of rupees 2,525 per share. It says company will be a key beneficiary of two-wheeler demand revival, and EPS has more than trebled in last 3 years, and it expects to more than double over next 3 years.
All right, Sudarshan, lots of positives there. So the two-wheeler market, that's zooming away in an otherwise weak market. Let's slip into a short breather on Business Lunch on that note, and we'll put the focus on the troubles at Air India Express when we come back. Stay tuned.
Welcome back. You're still tuned into Business Lunch on CNBC-TV18. Those are a couple of mid-cap numbers on your screen. Alkali Amines, the margins have come in at around 19.3% versus 18.9%. But I think there was a net profit fall, which has been quite steep. So around 21% decline in terms of the net profit to around 38.5 crores versus 48.6 crores. So that's, as you can see, the stock is down around 4.7%. Revenue has also declined on a year-on-year basis. Well, for the market, still weak. So let's concentrate on some important news. Let's get you the latest on the crisis at Air India Express. The airline had to delay or cancel over 70 flights yesterday after a number of crew members called in sick. Some of the crew have been terminated, while the airline also had to cancel a number of flights today. Danish is here to tell us more about this story.
Well, for the second day in a row, Tata Group's low-cost carrier Air India Express has cancelled 85 flights today due to unavailability of the cabin crew members. Today, the airline will be operating 283 flights instead of the usual 360 daily flights, which is almost a 20% reduction in the daily flights. The other group airline, Air India, will be supporting Air Express by operating 20 flights on their route. So overall, if we see over 100 cabin crew members reported sick at the last moment on late Tuesday night, which has impacted many domestic and international flights of the airline. And the airline has rolled out a curtailed flight schedule for the next few days, which means that there will be disruptions and they will be continuing for the few days to come as well. Well, the airline has also terminated 25 to 30 cabin crew members who allegedly instigated other crew members to report sick, and an ultimatum has also been given to the remaining crew to return back to work by 4 p.m. today, or they will also face termination. Moreover, the CEO Alok Singh has said that the senior cabin crew members have a deeper stake in helping to build and achieve the airline's vision, and the company is open to talk to all the employees and discuss whatever is concerning them. And the Labour Commissioner, the Chief Labour Commissioner, has also summoned officials of Air India Express and also the union members for a meeting which is scheduled for 2 p.m. today. And the CEO will also be holding a town hall with the cabin crew members today around 4:30 p.m. to address their concerns.
All right, Danish, very important piece of information there. And this is a subject that relates and actually affects all the consumers like you and me, Ekta. So, yes, what's going on there will be very, very critical and important. With that, we'll slip into a short breather on Business Lunch. When we return, we'll get you the latest from the ongoing war between Israel and Hamas. Stay tuned.
Welcome back. Still tuned in to Business Lunch this afternoon on CNBC TV18. Well, let's move on to an exclusive. SEBI has stepped up its scrutiny of startup IPOs. Nisha, you're tracking this story. Tell us more.
Yes, thanks for that, Ekta. Now, several sources that I have spoken to with direct involvement share with CNBC TV18 that the market regulator, SEBI, has increased the scrutiny on the disclosure of KPIs or key performance indicators by the IPO-bound startups. Now, the regulator calls for all KPIs shared with the private investors over the last 3 years to be disclosed in the DRHP for filing for the IPO. However, the issuers have the option to withhold any particular disclosure by giving their reason to SEBI. Now, this step is being taken because so far startups had been selectively disclosing the KPIs in their offer documents, and sources suggest that First Cry is a recent instance where SEBI called for additional disclosures and the company had to refile their offer document with the disclosures of additional KPIs. Now, sources suggest that all the IPO filings are undergoing the similar scrutiny, and this has led to concern and uncertainty in the startup world, including their investors and the iBankers and lawyers working on the listing process. Now, some startups are wary of disclosing certain KPIs shared with the private investors, and their concerns stem from the disclosure of granular details to the public. Now, these companies believe that such disclosures can really impact their competitiveness, as a lot of granular details are shared with the investors who also aid the startups in strategy as well as scaling up. Now, sources also point out that this issue is creating a friction between the startups and their investors as the flow of information is getting restricted due to the current concerns. While the industry is looking for a solution and also standardization of a clear framework with regards to the KPI disclosures, many in the industry I have spoken to believe that in the meantime, the return of the startup IPOs will get delayed and the process of receiving a SEBI clearance will get complex.
Okay. All right, Nisha. Thanks very much for that. So important story there. Let us now shift focus to the latest from West Asia. US President Joe Biden now says that the United States will stop providing weapons to Israel if its military launches an invasion of Rafah. CNBC's Dan Murphy has the latest on this story.
This decision to halt this weapon shipment to Israel is perhaps more symbolic than material. It is, of course, reflective of the fracture that we see in the US-Israel relationship and what appears to be clear concern now from the US side, and at least from President Biden, that he is concerned about how Israel is conducting this war and, of course, its threats to launch a full-scale invasion into Rafah. The US has paused at least one shipment of weapons and said it's going to be reviewing others. But it's also important to stress here that President Biden has still said the US will continue to make sure Israel is secure. That includes supplying ammunition for the Iron Dome and also ensuring Israel is equipped to respond to attacks. So what we've seen here is not necessarily a full halt of all arms. Rather, it is just one shipment of arms that is being paused. Of course, this threat to halt all arms is designed to pressure Israel to halt that threatened invasion of Rafah, where we see millions of Palestinians still seeking shelter. The Israeli military, in response, playing down this situation, playing down this shipment holdup, saying it's going to resolve any disagreements with the Americans behind closed doors. Of course, all of this also coming as we see ceasefire talks continuing. Hamas has said it's not going to make further concessions to Israel after we saw the Israelis pushing back on the Hamas proposal earlier this week. Delegations from Hamas, Israel, the US, Egypt and Qatar have all been meeting in Cairo since last Tuesday to try and talk this through, to try and hammer out an agreement that would ultimately stop Israel from going into Rafah. It would allow prisoners to be exchanged, hostages to be released and arms to be laid down. However, we are not at that point just yet. And NBC News now reporting that Prime Minister Benjamin Netanyahu has said that the military will enter Rafah with or without a deal with Hamas. So that's where we stand right now. It's back to you.
All right, so that's the latest coming in that conflict. So Ekta, it's time to say goodbye to all our viewers. No let up inside. The market continues to be under pressure, but goodbye from us. Mid-Cap Radar comes up next.